ASML experiences its largest plunge since 2008 as earnings season volatility looms over U.S. stocks. While ASML's revenue of €7.47 billion surpassed the market expectation of €7.17 billion, its third-quarter orders were only half of the forecast, and the company lowered its sales target for next year. ASML stated that despite strong demand for AI chips, orders for other chips, such as logic chips and memory chips, have fallen short of expectations. This has been reflected in the market, where non-AI-related segments of the semiconductors SOXX index saw sharper declines, while AI chip companies like NVDA and AMD experienced smaller drops. It's worth noting that ASML's earnings report was leaked early, initially scheduled for release tomorrow, causing an intraday waterfall drop in the Nasdaq and SOXX. This sudden release exacerbated panic selling, resulting in ASML's largest adjustment since 2008. This also serves as a reminder that earnings season has arrived, and upcoming reports will be crucial for October. I believe the biggest risk for U.S. stocks during this earnings season lies in the need for a technical correction after significant rallies. We may witness situations where companies report earnings above expectations, but the stock still declines after the positive news is priced in. This could replicate what happened with NVIDIA in the previous earnings season, where its report exceeded expectations, but the stock still dropped 7% in after-hours trading. The reason is that U.S. stocks have rallied too much, with the RSI, Relative Strength Index, showing severe overbought conditions, consistently trending upwards without significant pullbacks. This is primarily due to macroeconomic factors, such as the unexpectedly strong U.S. non-farm payroll data, combined with the irrational demand for NVIDIA's AI chips fueling an AI-driven rally. The bullish market driven by both macroeconomic factors and AI hype makes me concerned that earnings season may see positive results priced in, triggering a technical correction as an excuse for the market to consolidate. In other words, the fundamentals are largely intact, but the key issue is that stocks have risen too much. Lastly, I'd like to share my recent trading actions and rationale. I have been increasing my position in the U.S. Treasury ETF TLT, and this decision is based on similar reasoning. While U.S. equities continue hitting new highs, U.S. Treasury bonds are setting new lows daily. The market's overly optimistic outlook on the strength of the U.S. economy has led to a sell-off in bonds, with TLT now extremely oversold, mirroring the equity market's rise. In the face of earnings season volatility, I personally believe that TLT could serve as a good hedge. If the U.S. stock market experiences turbulence or if U.S. economic data weakens, TLT could rise against the trend. Even without this scenario, the current technical oversold condition presents a good opportunity. This article is merely a personal reflection and does not constitute investment advice.